International Limited Q3FY24 earnings conference call hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Bhumika Nair from DAM Capital Advisors. Thank you, and over to you, ma'am.
Good morning, everyone, and a warm welcome to the Q3 FY24 earnings call. International. We have the management today being represented by Mr. Manish Manoj, Managing Director and CEO, Mr. Q3FY24, Deputy Managing Director, Mr. Amit Uplenchwar, Director Group Strategy, and Mr. Ram Patodia, President Finance and CFO. At this point, I'll hand over the floor to Mr. Manoj for his initial remarks, post which we'll open up the floor for Q&A. Over to you, sir.
Thank you, Bhumika. Good morning, everyone, and welcome to the Q3 FY24 earnings call of Kalpataru Projects International Limited. I would start with the key highlights of our performance for the quarter, then follow that up with updates for each of our business verticals. The current financial year is a pivotal year for us as it has set the tone and foundation for robust performance for the merged entity. We have reported a strong quarter with consolidated revenue growth of 22%, EBITDA growth of 13%, and PAT growth of 32%. So in Q3 24, our standalone revenue is up by 18%, EBITDA grows by 13%, and PAT sees a whopping 30% growth. The growth is largely in back of improved execution and healthy order backlog position. We have seen a good inflow of high-value orders during the year as we have successfully forayed in underground tunneling with one project in Kanpur Underground Metro and additional L1 in Bhopal Underground Metro. Further, we have also secured the largest B&F order for constructing around 13 million square feet of residential building project on design-build basis. We are also favorably placed in a large airport EPC project in India. In addition to this marquee projects wins, we continue to strengthen our presence in T&D business in India and overseas markets. All these orders will help us to solidify our market position and capabilities going forward. On back of this large order wins, our order book is at a record high of rupees 51,753 crores. Our order inflows, including L1 of 6,000 crores, stands at over rupees 24,000 crores for the current year. With this, we have almost achieved 95% of our targeted order inflows for the full year 24. Our consolidated EBITDA margin is at 8.7% and the standalone EBITDA margin is at 8.3% in Q3 24. Our EBITDA margin is in line with project mix and reflects our consistent effort towards capability building and resource augmentation in order to support future growth. Our debt and working capital in our core EPC business continue to remain aligned with revenue growth and business mix. Our net debt in our core EPC business stands at rupees 2,784 crores, with working capital days at 112 at the end of Q3, compared to 117 days for a similar period last year. Our finance cost as a percentage of sales remains stable at around 2% at the standalone level. We expect net working capital days of around 100 days by the year end as we move closer to the financial year. Coming now to our business verticals, beginning with the T&D business. Our T&D business performed exceptionally well with revenue growth of 30% in Q3. The growth is driven by robust project progress and healthy order backlog. The T&D business witnessed a renewed optimism backed by rising adoption of renewables, increasing demand for power and need for upgradation of T&D infrastructure. The T&D segment is set for multi-year growth with robust tender pipeline in India and international market. We have secured orders of around rupees 7,500 crores till date in our T&D business and additionally have a L1 of over rupees 3,000 crores. The majority of L1 orders in T&D business are from India. Our T&D order book stands at rupees 19,367 crores at the end of December 23. On the international subsidiaries front, In LNG Sweden, we have reported revenue of rupees 237 crores in Q3 and 664 crores for 9 months financial year 24. LNG's order book at the end of December 23 stands at around rupees 2,100 crores. LNG has also successfully improved its capabilities in the substation business and improves its market presence by addition of new clients. In Brazil, Fasters revenue reached rupees 560 crores for 9 months 23 with a YOY growth of 77%. We continue to focus on organizational strengthening and closure of existing projects. Fasters order book stands at rupees 435 crores and additionally they have L1 of around 300 crores. We expect our T&D business to deliver good and sustainable growth going forward. Moving to our buildings and factories business, the business reported growth of 9% YOY in Q3. During Q3, progress on a few projects, especially in Chennai area, were impacted given by heavy rains. We expect to improve our revenue in Q4. Our B&F business continues to witness robust ordering momentum as we have secured orders totaling around rupees 6,450 crores, resulting in a closing order book of over rupees 12,000 crores. We continue to improve our competitive position and capabilities in the B&F business as we have secured large-size design-build building projects and improved presence in airport, data centers, and industrial projects. The business outlook in the B&F segments looks very promising across residential, commercial, and institutional buildings. Additionally, emerging areas like data centers, airports, and industrial plants also present a good opportunity for future growth. Our water business has achieved strong growth in the revenue growth of 52% in Q3, led by healthy project execution of water supply projects. Our order book stands at around rupees 11,400 crores at the end of December 23. The business outlook in water supply, irrigation, and water treatment projects remain very strong, and ordering activity is expected to pick up getting into next year. In our railways business, we continue to focus on project closure and selective order booking, given increase in competitive intensity. Our revenue for Q3 is rupees 281 crores, and closing order book stands at rupees 3,750 crores. In our oil and gas business, we have achieved revenue of rupees 200 crores in Q3, a figure close to the same quarter last year, primarily due to the lowering order in the domestic market. We are working to expand our international reach in the oil and gas business with focus on MENA region, given the large capital outlay to expand and upgrade the existing hydrocarbon infrastructure in that region. In our urban infra, we reported revenue growth of 130%. The growth is driven by a combination of execution of new projects and claim receipts in older projects. We have made a major breakthrough in our urban infra business with 2 underground metro rail tunnel projects. This will pave way to improve our competitive position and capability to bid for such large projects going forward. Additionally, the recently announced union budget has increased the capital outlay for infra development to over rupees 11 lakh crores. This will lead to enormous opportunities in the urban mobility segment. We are focusing on opportunities in elevated and underground metro rail, expressway, elevated corridors, etc. We believe that urban infra will act as a major contributor in growth going forward. In our road BOT projects, revenue per day has improved to rupees 50 lakhs per day in Q3 as compared to 52.6 lakhs same quarter last year. Similarly, for 9 months of FY24, revenue of road BOT projects has improved to rupees 57 lakhs per day compared to rupees 53 lakhs of similar period last year. The growth in revenue is largely driven by increase in traffic. We have infused around rupees 59 crores in the first 9 months of FY24, largely towards repayment of debt. For our Indore real estate project, till date, we have completed sale of around 70% of the inventory. In the current financial year, we have collected rupees 43 crores from the project. We are awaiting clarity on December 24. On the outlook front, the business environment remains very optimistic with large capital outlay and spend on infrastructure development in India and select international markets. In this backdrop, our diversified business mix, proven competencies, and strong financial profile give us enormous flexibility to be selective and focus on opportunities that align with our ethos of profitable growth and improving and maintaining the strength of our balance sheet. We continue to target consolidated revenue growth in the range of 20 to 25% and PBT of around 4.5 to 5% for full year 24. With this, I would request the moderator to open the lines for Q&A. Thank you, everyone.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Deepak Krishnan from Kotak Institutional Equities. Please go ahead.
Hi, sir. Thank you for the opportunity. Just wanted to check on your revenue guidance. You gave 20 to 25% and some deferral, for real estate revenue. But, what gives us confidence? Because first 9 months we are only at 19%, to sort of reach, or will we be at the lower end because of the 20%? How do we look at that? Maybe that's my first question.
Good morning, Deepak. Deepak, typically Q4 revenue for our businesses are extremely high, and given the order book visibility, we believe that our Q4 growth itself should be in excess of 25%. Now, if Q4 growth is in excess of 25%, we could be anywhere in the range of 21, 22% on an annualized basis. As of today, looking at the January numbers also, we're pretty confident of reaching those numbers, subject to anything, unusual which happens in the next 2 months. If you look at historically also, typically Q4 is always 30% plus of our revenue, and that's what similarly we expect in the current year also.
Sure. Maybe just on the order backlog and the outer year outlook, how do we look at the execution timeline for the 51,000 crores? Should we look at like a standard 2+ years, or because of its shifting more towards T&D, the execution can also be faster? And this may be related to that as T&D prospects increase. Should the margin profile also go back towards the last couple of years levels? How do we look at both margin and revenue from a medium-term perspective?
So from a revenue growth perspective, Deepak, it's very different for each of our segments, right? So typically when I look at the T&D segment, typical order book is 2.5 to 3 years. It's not beyond that. When I look at water, its typical order book execution cycle is 2 to 2.5 years. Similarly, building and factories is more in the range of 2.5 years. So if you ask me from a profile of order book, there's hardly less than 20% order book which will be more than 3 years. Everything else has to be delivered in the next 2 to 3 years. So, and that's where we're pretty confident of growth going forward also. As far as margin profile is concerned, obviously margins should be continuously improving given the increased size in revenue, given the optimism which will come in overheads and interest cost. And that's what is visible in the current year also when you look at on a quarterly basis. We believe that this trend should continue getting into next year also, but we'll be able to quantify it maybe by the end of Q4 or beginning of Q1 next year.
Sure, sir. Those are my questions.
Thank you. Next question is from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Hi, Manishji. Congratulations on a good quarter, sir. So my first question is on this GMC. So the intent of the merger was also to take GMC international. So if you can highlight post-merger, what kind of order wins or what kind of total addressable market opportunity have we seen, and how much of that has been converted? So if you can give some sense on how the TAM has increased for us beyond T&D in the international market, and going ahead, how do you see this panning out?
Good morning, Parikshit. Yes, you are right. One of our intent of merging the two entities was to take all our non-transmission business segments on the international front. We continue to explore those opportunities in roads, in building and factories, as well as in oil and gas. If you go back to our order book, roads, we already had a couple of very large wins in the previous year where we are focused on delivering. In the current year, we got into Seychelles on a large building and factories project in which we are executing. We're already executing 2 large projects in Maldives while we speak. We are further strengthening our capabilities and competencies in some more geographies as far as building and factories and roads are concerned. So parallelly, we continue to explore opportunities not only in these 2 segments but even oil and gas. So we have already created several inroads by qualification in a lot of segments in a lot of countries. My own belief is that as early as Q4, you will see some large wins coming in at least some segments which are non-T&D in the international front. We will continue to focus on a lot more segments going forward in the next year. But it's also very important for us to realize that some of our segments are very capex intensive, right? So when I look at a buildings and factory segments, when I go international, they're very capex intensive as compared to, let's say, a T&D or oil and gas segment. We also would like to balance that while we look at growth on the international market. So while our vision is clear, we are pouring into all of this, but the speed is at different levels depending upon the opportunity, depending upon the capex mix, and depending upon the maturity of the markets.
Okay. Sure, sir. So my second question is on the subsidiaries, these entities, international entities, Fasttel, Linjemontage, and even Shishubham Logistics. So if you can help us with their 9-month performance, like how much would have been profit or losses in these entities?
Sure. So, I think we have this data already in our presentation, which is on the website, but I'll give it to you again. On a 9-month basis, if you look at Fasttel, they have done revenue of around 664 crores with EBITDA of 21 crores and PBT of 11 crores. Linjemontage, sorry, that was Linjemontage at a Sweden level, 664 crores, EBITDA of 21 crores and PBT of 11 crores. If I look at Fasttel, they have done a 560 crores revenue with the EBITDA of just 1 crores and negative PBT of 35 crores. Negative PBT had a large amount of a bank guarantee encashment which happened in Q2 of around 18 odd crores. As said earlier, we expect Fasttel to get into that break-even level at a PBT level itself getting into next year. And Linjemontage should be doing much better given that they have very good visible order book and they have poured into new segments with new clients.
And Shishubham?
At the Shishubham level, we have done 81 crores revenue for 9 months with a EBITDA of 17 crores and a negative of 10 crores. Very similar to what they did in the previous year 9 months.
Okay. And just last questions are on this pledges and the promoter shareholding. So if you can give us some sense, have the banks or the lending institutions brought in some covenants on how these will behave, or is there any embargo on these that pledges will be capped, the promoter shareholding should not go below certain levels? If you can just refresh us on that.
So there are no specific covenants in terms of, saying that what should be the promoter holding of pledge. But yes, there's a kind of a discussion which has happened where the promoters have promised that one, pledge will go below 40%. And while we speak, we're already at closer to 39 or 38%, right? Correct me if I'm wrong. So that's the understanding. The pledge has been reducing every quarter. Even the last month, we saw a reduction of closer to 2% on pledge. So the underlying commitment from the promoters is the pledge will not go up, whatever happens, and they don't intend to sell any more of the stake. Those are the two underlying promoters, a kind of verbal things. It's not something in a written kind of note with bankers.
Okay, sir. Okay, sir. Those were my questions. Thank you and wish you the best.
Thank you.
Thank you. Next question is from the line of Gaurav from IIFL Securities. Please go ahead.
Hello, am I audible?
Yeah, Gaurav.
Yeah, thank you for the opportunity, sir. So, sir, as we are phasing out in our election year, so how do we see our closing order book for the year, and what could be our order inflows for 4Q and 1Q25? If you could just highlight some of the points on that part. And specific segment, like which are the segments which we are seeing traction, because railways have been sort of muted for us for quarter 2 now.
So Gaurav, as I said earlier, we expect all our L1 orders to get converted to order book in Q4. which means that we should be getting orders in excess of 6,000 crores in Q4. And with revenues of similar numbers, we should be ending the year with an order book of around 53,000 crores or in that range. As far as Q1 is concerned, it would be early for me to comment on that because typically, during election quarter, you might see some slowdown in a few sectors, but it might not be across the board. So when I look at the international order book, there'll be no impact. Whether I look at the B&F private sector, there'll be no impact. Whether I look at orders from the central PSUs, whether it is Power Grid, IOCL, GAIL, any of them, there shouldn't be any impact. Difficult for me to quantify at this stage, the Q1 likely order inflow or the impact. But at the year end, we expect order book to stay at the range of 50 to 53,000 crores.
Okay, sir. Sir, next question is basically on the margin. So we have seen a marginal improvement in the margin in the 3Q to around 8.3% on the EBITDA level. So, sir, how do we see trajectory going forward, and which segments are who are contributing to the margins for betterment of margins in the coming quarters, or are we seeing any sort of improvement in FY25 also from this level, from 8.3 level?
So I think we continue to be, being on our estimates of PBT in the range of 4.5% to 5%, and we stick to that stand what we had given at the beginning of the year. We believe that is what is achievable on an annualized basis in the current year. Getting into next year, we definitely believe there will be improvement in margins, but the exact quantification I'll be able to do, at the end of the Q4 call because all the business plans are being done now. But clearly, a visible improvement should be seen at the PBT level.
Yes, sir. And sir, could you just highlight on what sort of order inflows we expect in railways from FY25 because there has been some slowdown from a quarter or two now. If you can just highlight on the railway part, how are we seeing this on the order inflow front?
Sure. So, on the railway segment, while there are a lot of tenders which are coming out, the competition has become very, very intense. On an average, we are seeing 15, 16, 18, 20 players also bidding. We've been very conscious of not going the order book by compromising on profits. We already have a very good order book there, and our focus there is more on delivery and closure of projects. Personally, I do not see that segment being very bullish into next year, similar to, let's say, some of our other segments where I'm very bullish. The focus on railways even next year would be take specific targeted projects and make sure that, you focus on delivering on existing projects and closure of existing projects. While we say so, on the international front, there are 3 or 4 countries where we have now got qualified for railway projects also. We will continue to pursue that, but typically international projects takes their own duration of conversion, but that will also be an additional focus for us as far as railways business is concerned.
Okay, sir. So that's all from my side. Thank you.
Thank you.
Thank you. Next question is from the line of Bharat Seth from Quest Investment Advisors Private Limited. Please go ahead.
Hi, good morning, Manishji, and congratulations on good delivery.
Good morning, Bharat.
Manishji, I have 2 questions. One is on this, we are seeing a big opportunity in coming 5 years for India as well as internationally. And what we have been feeling that execution is becoming challenge, and particularly skilled labor force availability. So what are our strategy to improve that in order to execute within a timeline and no cost overrun? So what is our strategy, and how are we going to meet those challenges?
So, Bharat, I think you are exactly brought out our biggest challenge going into future. Yes, you are right. Availability of labor and resources, not only labor, resources across the entire segment is a challenge today. We're seeing attrition in the rate of 15 to 20% over the last 2 years across all our businesses, which was not there the last 5 years.
Correct.
Our focus is very different. Our focus is, we're trying to create a strong workforce with assurance over the next 12, 24 months in terms of giving them work, irrespective of monsoon, irrespective of any other segment. So one, we're trying to source in people which are more long-term in nature, whether it is subcontractor labor or at a labor level. Second, on the international front, we're trying to bring in people not only from the Indian segment, but also neighboring countries to India. So there are a lot of resources available in neighboring countries which are very good, which are equipped, and they are being now used for a lot of our international projects.
Okay.
Third, there's a lot more focus on training and skill development.
Okay.
Over the last 1 year, we have done more than 2,500 people. We have been trained on various aspects of skill development or any of those. So that's the third focus on making sure that we train as many people. I know all of them we can't retain, but whatever we can retain is good for us.
Correct.
It will be a challenge, and this will be a challenge given the election, euphoria also, and primarily in the month of April and May. But as an organization, will try and make sure that at least we focus on doing as much till March, and then April, May, make sure that labor-intensive projects are not so much in focus.
Correct. And sir, can you add it to that? I mean, how much automation can really improve our efficiency, and what are we doing for next couple of 3-4 years or 5 years timeline?
So, Bharat, automation will play a big role across all our segments. As of now, today, if you look at it, what we have done over the last 3 years, and we'll continue to build on that, is on various aspects. One, I could start with utilization of drones across all our businesses, whether it is on survey, whether it is on stringing, whether it is on project monitoring, all of that. Second, using shuttering and staging at a very advanced level. Today, 90% of projects we work on aluminum shuttering, where the cycle time comes down to 7 to 8 days compared to a normal 15 to 20 days in normal shuttering. Third, if you look at on the welding front in oil and gas and water and all of that, we are using automatic welders more than manual. Fourth, if you look at urban infra, our focus is a lot more on the newer machinery, newer equipment, whether it's on TBM or any of that, where productivity would be very different. So across all segments, right from utilizing of AI tools to utilizing things at the site, there is a continuous improvement. That will continue to be our focus. And if you look at our fixed assets, last 3 years, you'll see that we have invested closer to 1,000 crores in fixed assets, whether in the form of shuttering, plant and machinery, or investment in any of the new things. And that is visible in our profitability also. Compared to any of our industry players, you'll see that we have been much higher even on such a large scale, because all this automation is helping us improve our productivity.
Okay. And last question is about the working capital or borrowing. See, it is not, at the desired level which you are typically is always bringing down to below 95 days. So it's still high. So how do we really want, because in future also for higher growth on higher base will require a lot of working capital. So how are we going to bring down overall borrowing or remaining at the current level?
So Bharat, as I mentioned in my opening speech, we are targeting closer to 100 days of working capital by end of Q4.
Correct.
Typically, Q2 and Q3 working capital goes up. That's the typical nature of our business. If you see last year also, Q3 it was 117 days, Q4 we came down to below 100. Right? That's a target in the current quarter also, and the team is aligned and working towards it. That is as far as working capital is concerned. As far as focusing on debt, I think a lot of focus continues on getting rid of some of our non-core assets or divesting some of our non-core assets. Whether it is Indore, where we expect closer to 150 odd crores to come, 150 to 200 crores to come in the next 6 to 9 months. Also, our infusion in all our non-core sectors has reduced significantly. If you look at infusion, so that will also help us in bringing in working capital. We also continue to focus on divesting one of our large road assets. The mandate is already given, and we continue to speak to people to look at those options. So with all of that, I think debt we will be able to easily manage, and our internal target on working capital is to keep it below 100 days on an annualized basis. Quarter on quarter, sometimes, things could be very different.
Okay. Thank you and all the best, sir.
Thank you, brother.
Thank you. Next question is from the line of Dhruv Agarwal from Nivesha Investment Advisors. Please go ahead.
Yes, sir. Good morning, sir. So congratulations on the very good set of numbers, sir. So just wanted to understand your view on T&D segment on domestic on an international front. What kind of traction do you see in next 2 to 3 years, excluding the current order book that you have? And where is the higher margins, on international orders or on domestic orders, sir?
Good morning, Dhruv. Okay, we have seen the traction on T&D change significantly in the last 6 months in the domestic market. if you go back to my own calls over the last 2-3 years, we've been very, very, subdued on growth in domestic T&D. Last 6 months, we've seen huge orders being planned by REC and PFC on the entire renewable integration, whether it is in Western India, Northern India, or even in some pockets of Southern India, and the new regions which was expected to come in soon, whether it is the Northeast or the North. We've already seen orders of closer to 40,000 crores being highlighted by REC PFC for bidding in the next 3 to 4 months, which is closer to 3 times of what we have seen in the last couple of years. So with this, I believe that at least the T&D segment for the next 2 to 3 years clearly looks like an opportunity where we would have a big advantage. On the international front, our focus continues to be more in Africa and Latin, even with some focus on Middle East. We are now seeing funding agencies coming back in Africa on majority of the countries. All these funding agencies during COVID had a different view on some of these countries given the revenue shortfall in those countries. But now, lately, last 3 to 6 months, we've seen a lot of tenders coming up in a few markets, primarily Latin and Africa, where international agencies are coming back. Given the thrust of funding by international agencies, we expect that international markets also should do well. As far as profitability is concerned, I think, whether it's domestic or international, we continue to be working at a similar level of profitability, which is at 9 to 10% or 9 to 11% at the EBITDA level and 5 to 6% at a PBT level.
Okay. One more question related to that only. Sir, do you see any competitor on the international orders, sir, on international front?
So we do see competition in various countries across the globe. It's very different in different countries. In MENA, typically it's Indian and the local Middle East players. When you go to Latin America, it is Spanish players, Indians, and a few global players. When you go to Africa, it's primarily Chinese and Indian. Yes, competition continues to be what it is. But given that we've been in this market, some of these markets for 10, 15 years, you clearly have an advantage in terms of the labor force, the knowledge of the geography in the region and the costing. But competition continues to be what it was in the past. We've not seen as intense competition as in railways. So it's not like we have 20, 25 players. We'll have 6, 7, 8 players on all projects, whether it is domestic or international.
Okay. All right, sir. So, while executing the orders on T&D segment, what is the biggest challenge that you see, sir?
So I think the challenge is different in domestic and overseas markets. I think the domestic market, the challenge continues to be on approvals, whether it's on right of way, whether it's on environment and forest clearances, which are happening much faster compared to the past. But those challenges continue to be, delaying projects on the domestic front. On the international project, the challenges are more, the larger framework like the Red Sea issue where freight gets impacted or, any unexpected event which happens everywhere. While we protect ourselves through ETGC cover and all of that, but challenges are very different depending upon a country and depending upon a project.
Okay. So just last one question, sir. Let's say that CAE has increased the investment for deploying transmission infrastructure, including transmission lines, substation, to rupees 4.75 trillion from 2.44 lakh crore previously. So can you give some color on how do you see the demand to roll out from this increased expenditure and what kind of market share can Kalpataru be able to attain from this and what kind of EBITDA margins you can expect, sir?
So on the T&D front, typically in the domestic market, we've been into that range of 15 to 20% market share in the last 10 to 15 years. A few years could be up plus or minus. And I believe that we should be in that space as far as the T&D space is concerned going forward. On your question on the huge expansion which is being planned, that's exactly what I said earlier, that next 2-3 years we will see a huge growth in the T&D segment, and we will have to just make sure that the supply chain does not get locked up and labor resources are available to deliver. As far as margins, I said earlier, we continue to be bidding in that range of 9 to 10% EBITDA with 5 to 6% at a PBT level.
Okay, so my understanding is correct, 4.75 from 4.75 trillion, you would be able to attain 15 to 20% of market share, right, sir?
Yeah, over the next 3 to 5 years. This is not numbers which is happening in 1 year.
Okay, fair enough, sir. Thank you so much, sir, and all the best for the future, sir.
Thank you.
Thank you. Next question is from the line of Vaibhav Shah from JM Financial Limited. Please go ahead.
Yeah, thank you, sir. So one clarification, our guidance on the revenue side and the PBT margin side, it's on standalone level, right?
Yes. Our guidance is more at a standalone level of growth of 20 to 25% in Q4 and PBT in the range of 4.5 to 5%.
Okay.
But, very important to understand, a lot of our core transmission projects also now get into console. So slowly getting into looking at the long term, you have to start looking at console numbers. So if you look at Q3 also, there's closer to 250 crores of revenue in console numbers, which comes from Saudi, which comes from Tunisia, which is all through a subsidiary route. So I think going forward, it's important for us to look at the console numbers because now majority of numbers are core business. The road SPVs or, Shubham is hardly any number. So right now, yes, the guidance is more on a standalone, but going forward at a console level also, we will be targeting margins in excess of 4.5%.
Okay. So secondly, what capex have we done in 9 months and what are our plans for the full year and next year?
So 9 months capex has been closer to 200 plus crores. We expect to do another 100 plus crores in Q4. Could be slightly more than that. We have not still finalized our capex plan for next year, but it definitely looks like being higher than the current year. It might be in the range of 400 to 500 crores, given that we have poured into underground metro, which also requires some capex. And we're looking at some international projects also in non-T&D segment, which might require some capex. So current year, we should be in the range of 300 to 350 crores. And getting into next year, it's going to be higher than that. I'll be able to quantify that at the end of Q4 when in my analyst call for Q4.
Okay. And sir, lastly, on the underground metro opportunity, so we would be bidding in JV with another player, but entire work will be done by us?
So I think it's a JV, proper JV, where work will be done by both the partners in the form in which the JV is divided. It could be different proportion of work. It would be different segments of work which we'll be working on. But it's not that we would be doing the full work. It will be the JV's responsibility, and based on whatever the JV agreement has been signed, we'll be working on that.
So particularly in underground projects, we would also be doing the tunneling portion?
Yes, we will be doing the tunneling portion for sure, and we are investing in a TBM machine also, which I said earlier that there would be a capex going in for a TBM machine also.
So it could be in the range of 50 to 100 crores, the TBM part for next year?
Yeah, sure. It could be even more than that. Let's see how many projects we win, but definitely in the range of 100 plus crores.
Okay. Thank you, sir. Those are my questions.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. Next question is from the line of Arfat from InCred. Please go ahead.
Yeah, thanks for taking my question. That's on grades of numbers. So my first question is on the divestment. So say if you play in terms of we divest by FY20, and what is the timeline to divest other assets like seasonal logistics and also indoor, make it completely out of business? And what you are expecting from all this?
So, as I mentioned earlier, indoor project we expect to be fully divested by December 24. We have sold off close to 70% of our inventory. The balance should be sold off quick, maybe in the next 3 to 6 months. By December 24, internally, we are planning to be completely out of Indore. As far as road assets is concerned, the largest asset, WEPL, we have already appointed bankers. VEPL, sorry. We have already appointed bankers, and we have a non-binding offer right now on which we are working on. We believe that in the next 3 to 4 months, we should get some clarity on that. As far as the other 2 road assets are concerned, they have a smaller lag life left. One of them is 7 years, one of them is 9 to 10 years. We have not yet looked at divesting them at the current stage, but once we have done with the big asset, we will look at that also. As far as Shubham Logistics is concerned, clearly we believe it's non-core to us, But we don't think the divestment would happen in the next 12 to 15 months. That could be something which we would target in 25-26. Given given the situation in that business today, where things have to improve significantly, hopefully post elections. So we believe that diversification could happen only in 25-26, not before that.
Okay, fine. And sir, lastly on your promoting. So if you look at the past few pledges coming down, but promoter holding itself is coming down. So anything on that, sir?
Sorry, I missed that. Pledge is coming down, but sorry, I missed the second part. Pledge is coming
holding. If you look at the promoter holding, is coming down.
So I think promoters holding came down, one because of merger, and second because something they sold around 6 months ago. There's no movement in the last 2-3 months, but we have seen pledge coming down. So there was a further reduction of 2% in January. Now pledge is at around 39% levels. So we see continuous reduction in pledge, and you should see further reduction happening in the next 2 months. So I think, we'll only see a downward trajectory on that, and hopefully a significant downward trajectory going into the next 6 to 12 months.
Okay, fine. That's it so much. Thank you.
Thank you. Next question is from the line of Thomas George, an individual investor. Please go ahead.
Good morning, Mr. Manoj. It's good to connect with you and the team again. Just have a query on future incubation of businesses. Do we see any of our businesses within the overall holding of our company being listed either overseas or in India in the very long term? And what is our view on incubation of new businesses at Kalpataru projects?
Good morning, Thomas. Thomas, on the first question of any of our businesses in the domestic and international front getting into an environment of listing or capital raising, as of now, I do not think we have any such plans, at least for the next few years, whether it is the Swedish entity or the Brazilian entity or any of the others. As far as incubation of new businesses are concerned, we would continue to explore opportunities within the value chain where we exist. So whether it is a transmission value chain or the urban infra or the building and factories or the oil and gas or railways, we will continue to explore opportunities within the value chain, whether it's on manufacturing, whether it is on, let's say, automation, whether it's in investments in small players, who are doing excellent work in this value chain. Beyond the value chain, beyond the 6 existing businesses which we have, we do not believe that we need to diversify in the next couple of years, given the huge opportunity in this business spaces. We also are conscious of the fact that any new incubation and diversification requires also huge capital. Right? It starts with some infusion of equity, then taking those 3-4 projects, and then building everything. As of today, at least from a 2-year perspective, we believe that the segments where we exist have huge opportunity in domestic and international, and we'll focus on those segments only.
Great, sir. Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. Next question is from the line of Lakshmi Narayan KG from Tunga Investments. Please go ahead.
Yeah, thank you. A couple of questions. So first, in terms of your BNF vertical in India, what has been the order book in the BNF vertical in India?
So if you look at the BNF vertical in India, our order book as of 31st December is around 12,000 plus crores. In the current year, we have won orders of around 6,500 crores in the BNF vertical. Additionally, we are L1 and some orders. So our closing order book right now is around 12,100 crores.
And this will be executed over a period of what time?
So our typical BNF orders are in the range of 2.5 to 3 years. So my own view is a significant portion of this order will be delivered in the next 2 years, with some portion getting into the 3rd year. There's nothing which is beyond 3 years as of now.
And what are the major wins you have got this last 9 months?
So in the last 9 months, as I said earlier, we have had wins in industrial engineering. We have had win in a data center. We are L1 in a large airport. We've taken up huge residential projects in southern India, which is on a design build basis. We've got, a couple of education institutes. It's across residential, commercial, education, data centers, airports, and industrial projects. It's a mix of all of them.
Got it. Is it, in the places where you have won, what has been who have been your typical competitors in some of your top 2 or 3 wins in terms of sizes, the ones which you spoke about, data center or the other industrial one? Do you find competition from smaller guys or the L&Ts and the Shapoorjis?
I think we see competition from everywhere, given on the size of the project. If the project is, let's say, 1,000 crore plus, typically it's the 4 or 5 large guys who come in. If the value is less than 500 crores, you see 8, 9, 10, 12 bidders also. But the good part is it's healthy competition. We do not see any more people bidding at irrational prices or very low prices. So even if you win or lose with a few % here and there. And that's positive for the industry as a whole, because healthy competition will help all of us do better.
Sure. And I was just glancing through some of these requests of information, and I see that there are these stringent conditions these days in terms of continued profitability at a PBT level, better net worth, better completion record without any delays. Is that something helping you to get more projects where these other switch players lose out? In a sense that is the industry getting consolidated in the DNF in India?
So I think all the industry players have that credibility of net worth, profitability and execution. So to me, at least the large 10, 12, 15 guys, we see them doing extremely well, which includes us also. Definitely, the entire RERA mechanism has helped us in the B&F segment, at least in the residential segment, where cash flows have improved, given that the deployment of utilization is governed as per RERA regulations. So definitely that's helped on the cash flow front. But as far as competition is concerned, I think the large players or the good players who have been doing well continue to be competitive across all segments.
Got it. And what's the typical returns you make? What is the kind of ROEs you make in this segment? Whether it is above your normal at a consolidated level, or it is below the normal, below your company average?
So at a B&F level, typically our ROCE is slightly higher than, let's say, some of our other segments like railways and oil and gas. It's very similar to T&D, more in the range of 16 to 18%. At a EBITDA level, this business clearly does better than some of the other segments, but at a PBT level, they are back to those 5 to 6% levels.
And what is your differentiation in this thing other than your technical capabilities? Is that something which you bring to a table that others don't bring in, because you're sitting on a very good order book there compared to the revenue run rate you have? What is the any distinct differentiation you have in that segment?
I think it's a combination of 4 or 5 things. Combination of our long relationship with a lot of private sector and delivery over the last 10 years in various aspects of the business. Second, our availability of a huge labor workforce which has worked with us for decades together. Third, our ability to acquire and retain resources across all levels. Fourth, our design and build capabilities which we have built over the last 4 to 5 years. Fifth, our own values in terms of delivery, where we have delivered on every project, and you'll not find a single project which we have not delivered, irrespective of COVID or increase in steel prices or whatever else. So a combination of 5, 6 things with that reputation of delivering on or before time has helped us achieve what we are today.
Okay. May I please another question or two?
Sure.
Yeah. So in this, how much of your projects will be fixed price project, and how much you have some kind of a variable mixed in?
So today, if I look at the total order book, fixed projects are around 35%. On a total 51,000 crores order books, you look at it, and variable projects are around 65%.
And this will be true for the B&F segment also?
So B&F would be different. B&F, the fixed portion would be more than 90%. And the variable would be closer to 10%. Sorry, I said opposite. The variable would be closer to 90%. I correct myself, and the fixed would be closer to 10%.
And one last question, in terms of the size of this DNS, right? So in the country, where would you stand in terms of your either order book or in terms of the size of operation? To just get a sense of proportion in terms of where you are in India. Are you on the top 5 or in the top 3?
So we've not done a kind of a benchmarking across with all players, but we personally internally believe that we definitely in all segments where we are today, we are one among top 5. All segments, which whether it is T&D, whether it is B&F, whether it is oil and gas, whether it is railway, and now the way we're getting into urban infra, very soon there also will be into that top 5 over the next few years.
And we see that because of RERA, things are eased up in terms of, you can construct that the cash flows are secure. But when it comes to the other PSU or quasi-PSU, some of this public infrastructure, especially the DNF thing, do you think the ease of doing business and getting the payments have actually considerably improved in the last couple of years? How do you think about those things?
No, I think we've not had challenges on even cash flows from any of the PSUs. So I don't think that over the last couple of years, post the entire COVID, environment, even during COVID, I think the PSUs helped us a lot. We do not see any challenge in terms of the large centralized PSUs. At a state level, a few states we've had some challenges given, elections and government changes, all of that, but it's only a timing issue. It's not something which we're worried from an overall long-term perspective.
Got it. This is very helpful. Thank you so much.
Thank you very much.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. Next question is from the line of Anwani Amit from PL Capital. Please go ahead.
Hi, sir. My question is on the pipeline. So you mentioned the robust pipeline in T&D domestic by REC of about 40,000. Just wanted to understand if do you have chalked out what could be the pipeline for next 12-18 months? And this 40,000, does it include any large HVDC order or component? And similarly for international orders also, if possible for you to give a color in any major geographies with respect to the T&D pipeline for Kalpataru.
So Amit, have you drawn the exact pipeline from a next 12 to 15 month perspective? My answer would be not getting into details the way we have gone for the first 3 to 6 months. The next 3 to 6 months is a number which I have given. It includes a few HVDC projects also, which are already there in the PFC RSC list of projects to be bidded. It could be maybe 3 months. It could be slightly beyond 6 months given elections, which could be happen in Q1. But the path which is visible, given that whether it is through the budget outlay or whether it is through the Power Ministry's plan, is that next 2-3 years you'll see huge opportunities in the T&D segment. So that is clearly visible. We've not quantified things beyond the numbers except for the larger plans which are already available on the government website. As far as the international market, again, as I said earlier, the 3 markets where we focused on LATAM, South Africa and Middle East, traction has improved significantly. And growing that business at a 15 to 20% minimum will not be a challenge for the next 2 to 3 years.
Sure, sir. And my understanding, so with respect to non-core, we'll be able to wind up only Indore this year, and rest of the projects will take at least 2 years?
No, Indore as well as we should be exiting one of our road assets, the largest one, VPL.
So in FY25, is this what you're targeting?
Our internal target definitely is 24-25.
Great, sir. Thank you. Thanks for taking my question.
Thank you.
Thank you. As there are no further questions, I would now like to hand the conference over to Ms. Bhumika Nair from DAM Capital Advisors for closing comments.
Yeah, I would like to thank all the participants and particularly the management for giving us an opportunity to host a call. Thank you very much, sir, and wishing you all the very best going ahead. Thank you very much.
Thank you, Bhumika. Thank you, everyone.
Thank you. On behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.